Something is building underneath the silver market right now that the retail crowd has completely missed. And if the positioning data I'm looking at resolves the way it historically has, next week could see a move so fast and so violent that most traders will not even have time to react before it is over. Now I already know what you were thinking. You were thinking this is just another weekend analysis, another round of chart talk dressed up as urgency, another prediction that quietly disappears by Wednesday. Stay with me, because what I'm about to walk you through is not opinion, and it is not chart pattern guessing. Everything in this analysis is sourced from COMEX warehouse reports, the CME Group's commitments of traders data released Friday at 3:30 p.m. Eastern, and institutional research from Bank of America's commodity desk and Goldman Sachs macro strategy. I'm going to show you 3 specific things before this video ends. First, I'm going to show you exactly what the current positioning structure in silver looks like and why it is historically dangerous. Second, I'm going to walk you through what is happening inside the COMEX silver warehouses right now that no one in the retail space is talking about. Third, I'm going to give you both the bull path and the bear path with exact price levels and realistic timeframes so you can make an informed decision before Monday's open. But none of those 3 things will make sense unless we build this from the ground up, so do not skip ahead. Let me start with a COT report released this past Friday. As of the Tuesday, June 2nd snapshot, commercial traders, the large institutions, the banks, the refiners, the entities that actually move physical metal, are net short silver by a position that has expanded to levels not seen since late October 2024. Managed money, which is largely speculative hedge funds, is net long, and that long positioning has been building steadily since late May. On the surface, that sounds bullish for silver. A crowded, speculative long against commercial short pressure is the classic setup that precedes large moves in either direction. Here is where it gets dangerous. When speculative longs get this extended and the commercials hold this much short pressure simultaneously, the market is essentially a coiled spring. And the direction of the release depends on which side blinks first. Before we get to that specific trigger question, we need to talk about what is happening in the COMEX warehouses, because this is the piece that changes everything else. As of Wednesday, June 4th, COMEX eligible silver inventories dropped to 271 million ounces. Registered silver, the metal that is actually available for delivery against futures contracts, sits at just over 38 million ounces. That registered figure has been declining for 6 consecutive sessions. Now compare that to the open interest sitting in the July contract. July silver open interest as of Friday represents a potential delivery obligation that is not covered by the registered inventory without significant drawdown. This is not a supply crisis today, but it is a structure where any unexpected surge in delivery requests could force commercial shorts to scramble. And that is exactly the kind of mechanical pressure that produces violent intraday moves. The Silver Institute's 2024 World Silver Survey documented a 6th consecutive year of structural physical deficit, with industrial demand absorbing supply at levels the market has not seen in the modern era of electrification. Solar panel manufacturers alone consumed over 232 million ounces in 2023. That structural backdrop means any short-term positioning squeeze occurs against a fundamental floor that does not dissolve easily. Now, I need to connect this to the macro picture, because silver does not move in a vacuum. The Federal Reserve's June 11th and 12th meeting is the most important catalyst event sitting directly in front of this market. Fed funds futures, as of Friday's close, are pricing a 91% probability of a hold at current rates, with the first cut now being priced into the November meeting. That matters for silver in a very specific way. A hold combined with dovish language in Powell's press conference historically compresses real yields on a short-term basis. Silver's correlation to the 10-year TIPS yield is deeply negative, meaning when real yields fall, even marginally, silver tends to react with outsized speed relative to gold. The gold-silver ratio right now sits at approximately 88-1. The historical mean compression target during risk-on environments is closer to 70-1. Bank of America's commodity research team, in their May 2025 metals note, maintained a 12-month silver price target of $38 per ounce, citing exactly this ratio compression dynamic, combined with industrial demand acceleration. Goldman Sachs, in their April macro strategy update, flagged silver as one of their highest conviction commodity longs on a 6-month horizon, with a price objective of $36.50 by Q3 2025. Both of those institutional targets sit materially above where silver closed on Friday at $29.74 per ounce. Now here's the question I need you to sit with before I give you the 2 scenarios. Are you the kind of trader or investor who looks at positioning data, warehouse inventory trends, institutional research, and macro catalysts and forms a view before the move happens? Or are you the kind of person who waits until silver is already at $34 and the headlines confirm what the data was showing weeks ago? Because right now you're sitting at exactly that fork. The QOT structure, the warehouse drawdown, the Fed meeting, the ratio compression pressure, these are not opinions. They are documented, datable market facts. Strong hands see the setup and position accordingly. Weak hands wait for the crowd to confirm what the data has already said. Which one are you? Now, let me give you the two scenarios. Bull path. If the Federal Reserve on June 12th delivers a hold paired with dovish language that signals a rate cut in September rather than November, real yields compress immediately. The dollar index, which closed Friday at 104.3, weakens toward 102.5 on a 5 to 7 session basis. That dollar weakness, combined with the existing speculative long structure in silver, produces a squeeze that could push spot silver from 29.74 to a test of 32.50 inside of 2 to 3 trading sessions. If registered COMEX inventory continues to decline through next week, and we see any uptick in delivery notices in the July contract, the squeeze pressure multiplies. In that scenario, $34 to $35 becomes a realistic 30-day target, and the gold-silver ratio compression toward 82 begins in earnest. Bear path. If Powell's June 12th statement is interpreted as hawkish, if he signals that the November cut is not certain and that inflation data still concerns the committee, real yields spike. The dollar strengthens back above 105. Speculative longs in silver get liquidated fast. Those managed money longs that have been building since late May begin to unwind, and you can see silver retrace to $27.80 or even $26.50 on a fast flush before stabilizing. In that scenario, the commercial shorts cover into the liquidation, the QOT structure resets, and the setup I described earlier rebuilds over the following 4 to 6 weeks. Which scenario plays out depends entirely on 12 words from Jerome Powell. And that is not hyperbole. That is what the positioning structure has created. Before I close, I need to be honest with you about the risks in this thesis. Silver is one of the most volatile commodities that trades on a major exchange. The same positioning structure that produces a $3 upside move in 48 hours can produce an equally fast $3 downside flush if the catalyst resolves against the bull case. Timing risk here is real. If you enter a position before the Fed meeting and Powell is hawkish, you are in the middle of a liquidation event. The thesis could also be wrong on the warehouse side if eligible silver gets re-registered quickly, which has happened in prior cycles, and which would reduce the delivery pressure dynamic entirely. I am not dismissing those risks. I am naming them because anyone who does not name them is not giving you analysis. They are giving you promotion. Here at Aurelius Metals, the job is to give you the framework, the data, and the honest risk picture so you can make the decision yourself. The two scenarios are live. The Fed meeting is 96 hours away. The positioning is set. The warehouses are where they are. What I cannot tell you yet is whether the commercial short holders are about to get squeezed into the most painful cover of this cycle, or whether the speculative longs are about to hand them the biggest gift of the quarter. And the answer to that question arrives Wednesday afternoon. Are you going to be positioned to read it in real time, or are you still going to be deciding when it is already too late?